Welcome to our video on fund-of-fund FOF schemes, a unique investment strategy in the mutual fund landscape. We'll explore what they are, how they work, and their distinct advantages and disadvantages. A fund-of-fund is a mutual fund that invests in other mutual funds rather than directly in stocks, bonds, or other securities. This approach offers diversification across various asset classes and fund managers. One of the key advantages of FOFs is the professional management and diversification they provide. By investing in multiple funds, they spread risk and potentially enhance returns through expert fund selection. As of June 2024, the global AUM for the fund-of-funds industry is estimated at $132 trillion. This marks a record high, highlighting the growing popularity and trust in this investment strategy worldwide. However, FOFs generally have higher expense ratios compared to traditional mutual funds. This is due to the dual layer of fees, the FOF's own management fees and those of the underlying funds. A typical mutual fund may have an expense ratio between 0.5% and 2.0%. In contrast, FOFs can see total expense ratios reaching 2.5% to 4.0% or more, especially in niche categories like hedge funds. Regulatory caps on expense ratios exist in many jurisdictions, but these often exclude underlying fund costs. It's crucial for investors to understand the all-in costs when considering FOFs. Despite higher costs, FOFs offer access to specialized investment strategies and asset classes that might be difficult for individual investors to access directly, such as private equity or hedge funds. FOFs also provide convenience and simplicity for investors who prefer a hands-off approach. By investing in a single FOF, they gain exposure to a diversified portfolio managed by professionals. However, investors should be aware of potential overlap in holdings among the underlying funds. This can reduce the diversification benefits and lead to concentration in certain sectors or assets. Another consideration is the potential for lower returns due to the higher expense ratios. The additional fees can eat into profits, making it essential to evaluate the net returns of FOFs. FOFs are suitable for investors seeking diversification and professional management without the need to select individual funds. They are particularly beneficial for those with limited time or expertise. It's important for investors to assess their risk tolerance and investment goals when considering FOFs. Understanding the underlying fund's strategies and performance is crucial for informed decision-making. FOFs can be an excellent choice for long-term investors looking to build a diversified portfolio. They offer exposure to a wide range of asset classes and investment styles, managed by experienced professionals. In conclusion, fund-of-fund schemes offer unique benefits and challenges. While they provide diversification and professional management, investors must weigh these against higher costs and potential overlap in holdings. For beginners in mutual fund investing, FOFs can be a valuable tool for building a diversified portfolio. However, it's essential to conduct thorough research and understand the fee structure before investing. Thank you for watching our video on fund-of-fund schemes. We hope this has provided valuable insights into their workings, benefits, and considerations. Stay informed and make wise investment decisions.